Okay, good afternoon and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and I have a very special guest here with me today, Tom Sosnoff from Tastyworks. Many of you joined us here back in January when we had him back. We were very sad to not be able to have him back here in March, but glad that he's here with us today. Tom, are you on? Can you hear us? Let's see, looks like he's on mute. Let's see if we can get him off of mute. Hey, Tom, if you can hear us, I think you're on mute. I'm trying to get you off of mute.
Can you hear me now, Tony?
Yep, Tom, loud and clear. Thank you so much for joining us. Thank you so much for joining us this afternoon.
I'm happy to be here. Let's see if we get a little video. I don't think I can play a video, right?
It's okay. You can.
Oh, no, I just can't. For some reason, it's...
Oh, 1 second. I know I can... You can try now.
Let's try. There you go.
Great.
All right.
Good to see your face. Are you working from home?
I am.
Good.
And I'm excited to be here today, Tony. This is gonna be good.
Yeah, I'm excited. We have some great questions lined up for us to look at today. You know, like we said, everyone missed you back here in March. Glad to have you back. So let's go ahead and get started here. So just a quick disclaimer before we get started here. What we're going to discuss here with Tom is going to be demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So today we're going to do a fairly quick introduction for Tom, and most of you know who he is, but we're going to do a quick brief talk about where we currently see the markets. We're talking a little bit about volatility, what he's trading, how he's looking at the markets, and then we're just going to dive into the questions. You guys submitted some fantastic questions that we're going to go over here today. Tom and I have already reviewed most of them. We're going to take a look at that and make sure that we're going to also, if we have some time at the end, to answer any additional questions if we have time. So let's go ahead and get started. Now, like I said, most of you know Tom Sosnoff, but I'm going to give Tom just a few seconds to give a little brief introduction as to who he is, your background, and then we'll dive right into it. So Tom.
Sure. So, so I'm a lifer. You know, Tony, when I was 13 years old, I started caddying, and when I started caddying, there was a bunch of older guys there, and they used to tell us, hey, we're lifers, kid. And it's like, I'm not sure if that's something to be proud of, but whatever, it sounds good. It turns out I'm a lifer in the world of finance and more specifically options. My background is pretty simple. For the last almost 4 decades, starting in the early 80s, I started off as a floor trader in Chicago on the Chicago Board Options Exchange for about 20 years. I traded option products to 1999, 2000, when we decided to leave the floor and build Thinkorswim. Built Thinkorswim from 1999 to 2009. We're a public company. We got bought out by TD Ameritrade. I left after 2 years because I wanted to do something else, and started Tastytrade. We started Tastytrade in 2011. We are still doing it 9 years later. And in 2017, we launched Tastyworks, which is an online brokerage firm. It's kind of Tastytrade is a it's a digital financial media company, actually the largest in the world now. And Tastyworks is one of the fastest growing brokerage firms in the world on the more traditional side. You know, not like a free app like Robinhood or something like that, but more like a more traditional broker like the Thinkorswim we built, or, you know, Schwab, Fidelity, E-Trade.
Yeah.
We just streamlining our efforts to build technology, and we spend a lot of money now on Tony on both content and technology that speaks to our content. So it's a big part of our kind of philosophy.
Yeah, so I mean, I can speak to the content that you guys generate. I think it's fantastic. And I love the fact that you guys take a very quantitative approach also to how you guys view options. And that's very aligned with our DNA that we have here at OptionsPlay. You know, going back to Thinkorswim. I learned how to trade options through the webinars that you used to host on Thinkorswim, but this was 13 years ago.
I
You know,
know.
I was working.
I love that. I love that story. I
You know,
love it.
I worked at a company called Forex.com. We were currency traders, and you know, heavy in technical analysis. And back then, Thinkorswim was really one of the key platforms in being able to chart all these different markets, and that's how I learned how to trade stocks, futures, forex, options, and now we're here. I'm so glad to have you here with us today.
Yeah, it's cool. Listen, we've known each other for a while, and it's just, you know, I love spending afternoons talking. Now the markets are closed, I've got nothing to look at. We could sit here all night, as far as I'm concerned. And also, just so everybody knows, to make it easier, so that Tony and I'm not reading any screens or anything. I'm just listening to Tony. But if there's anybody has any questions, Scott, Ryan, and Scott, Ryan, and Chris are all on. Those are three people that run Tastyworks, and they're from our trade desk. So you can chat in and ask them. We're obviously all working from home, but you can ask them any question. They run risk and they run the actual trade desk. So you ask them any question you want about anything. Nothing's off limits. Scott's the CEO and he's on the chat. So just ask him anything you want. That way, Tony and I can just fire away and, you know, and keep you guys, you know, both. Tony, we call this edutainment.
I like that. That's great. I mean, I will say, for many of the 45-minute webinars that we do, we probably spend at least 45 minutes answering questions, and people love it. So I'm glad that we're able to do that. So yes, the Q&A window at the bottom of your screen, you can type in your questions. And Tastyworks has gracefully been able to provide, you know, people to help us answer all of these questions. So let's go ahead and get started while they go ahead and answer some of those questions. And please feel free to submit them in the chat or the Q&A window. So I want to start off talking a little bit about the markets, right? We've had a hell of a sell-off and a hell of a rally. Managed to break back above what I think is a major resistance level at 300. So from my perspective, markets are very much in a bullish state, but over the past few days, we've reached a bit of an equilibrium, if you will, as COVID-19 cases have spiked. But my base case is still don't fight the Fed, buy the dips. And we've been talking about the fact that the market rally that we've seen over the past few months, a lot of questions regarding how healthy is this rally? Is this just another bear market rally? And from my perspective, this market is much healthier than it was back in January and February. We're seeing not just mega cap tech names leading this market higher and dragging everything higher. It really is participation across the board, small cap, equal weight, large cap, everyone, no matter how you slice and dice this market. So my question to you is really regarding kind of how are you viewing this market? What type of symbols are you trading? Specifically, you know, how are you thinking about options? And then at the end, you know, what option strategies are you trading? And then, you know, lastly, I just would like you to comment, you know, with SPY's IV rank currently trading at 36, how do you view that, and how does that influence kind of your trading decisions and how you position for this current market? I know I asked a lot, but.
Sure. Yeah, there's a lot in there, but that's okay because this is what we do. So I'm impressed every day. I'm impressed by the breadth and the strength of this rally. There's no question about it. It got a lot further than I thought it would. You know, it's kind of like, you know, the eye test fooled me, and I think it fooled a lot of people. I wasn't surprised that we rallied from the lows because I thought we were grossly oversold, and there was too much velocity to the downside, and there was too much volatility. There was too much fear, you know, when we, you know, obviously on the way down and just the pure speed. But on the way back up, there's no question that I've been fooled by the last, let's call it the last 300 or 400 points. I thought we would probably trade in a range of 2,500 to 3,000 for, you know, for the rest of the year. The expected range, by the way, until after November elections is about 450 points. And so that's higher or lower. And I think that range, actually, if you look at my cursor right here, I just put it on the screen, Tony, and there's 155 days to go to November 20th, which is after the November elections. And
hey, Tom, if you want to share your screen, please go ahead and do so. I took it away to do the slides, but, you know, at this point, I think you can take over.
Let me,
I'll stop sharing my screen.
Yeah, let me find this for a second here.
It's a little green thing at the bottom. It says share screen.
Yeah, let's see. Where is it? I'm looking for it.
If you see your chat, it should be a green button.
For some reason, I think I might have to blow this up. Let me see. Here it is. Let's see, share screen, got it. And let's go to this, Tastyworks, share. Can you see the screen now?
Awesome, yep.
Perfect, okay. Sorry about that. So Tony, what I'm doing here, this is a, you mentioned the spiders, and the spiders are the S&P 500 ETF. What I'm gonna do is I'm gonna take my cursor, as you can see my cursor here, and I'm gonna take you to November, which is post-election, because November 20th is obviously just past the elections. And I'm gonna move it, it's 155 days from now, and I'm gonna move it to the right-hand side of the page, and you can see that it says plus or minus 45 points in the S&Ps. That's the spiders. That's 450 points in the S&P futures, 450 points. Now, just to put 450 points in perspective, from low to high, we moved 1,000. So it's a very measured move. What we're looking at, even though volatility is high, it's a very measured move we're looking at between now and November elections. And I actually like that number. I think that plus or minus 450 points is actually a really good number. Now, when I say that, the reason I'm saying that is because you mentioned the IV rank, which is up here. That's the SPY IV rank, about 35 right now. But what we didn't mention so far was that if we look at July implied volatility at around, let's call it 33% in the spiders, that's about 2 times the level of implied volatility the last time the S&Ps were at this level. So the last time the S&Ps were at 3,100, and it's actually, you can say 3,200, 3,300, whatever you want to say. The last time was in about November of last year, November, December, and then obviously in January of this year. Volatility was about 13, 14%, maybe 15, and now it's double that. It's 32, 33%. So we have double the volatility and the same kind of level in the S&Ps. So from a trader perspective, that makes it really interesting because that means option prices are about double what they were just 6 months ago or 7 months ago. That's the exciting part. And Tony, that's where I think the opportunity is for most option traders and most, as you would call them, and me too, strategists. So the strategic part to this business is really exciting right now because implied volatility is double what it's been normally with the market at these levels. And I would expect it to stay at heightened for at least through the election based on the expected move through the election. So that's the good news. The only thing I feel differently than you is I feel that the market has been the top of the funnel with the same 5, 7, 10 super liquid stocks are oversaturated at this point, and there's a lot of what I would call time premium built into these stocks. So when I look at stocks like Apple and Amazon, and basically the digitized top of the funnel, so all of these stocks that have carried this market so far, unless there's new leadership, and I don't see it coming from anywhere, I think the market has priced in a lot of time value or time premium to this recovery. And so I'm nervous that I'm not nearly as bullish as you are, but I do think that 450 point range from where we are right now, which means we could go up to 34, 3,500 would be the top end and down as low as, 24, 2,500. I think those numbers are pretty good.
I completely agree. And I would say that my bullishness has certainly been tampered a little bit by the last sell-off we've seen and kind of the equilibrium I feel the market has kind of found in the past few trading sessions. So I completely agree. So let's jump into some of the questions. I think this is a great way for us to have a discussion about the markets because I think you touch up on a couple of things, especially that IVX and the trading range. There were some questions about that. So I want to dive right into it. First question from Sunny. Sunny asks, when would you buy out of the money puts or calls and why? I think I have a good understanding as to how you're going to answer this, but I'd love to hear you answer that question.
Sonny, you can buy out of the money puts and calls on a very rare, on a rare occasion. It's not something that we do very often. In fact, if you've been watching or listening to me for decades, you rarely ever hear me say we're buying an out of the money put or call. But statistically speaking, there are 2 points when there is a very small, what we would call clustering effect in volatility, where the odds are not stacked that great against you. One is when and Tony had mentioned this before. One is when the IV rank, Tony, is under 10. The statistical chance of buying something is not that much worse than selling something. So IV rank under 10. And the other time is when you have a pure explosion in volatility and you're thinking about it on a short-term basis. There's a tendency when we see moves like we saw in February, end of February and March and April, there's a tendency on a short-term basis for very high unquantifiable implied volatility to cluster. So sometimes you'll get an opportunity on a short-term basis to buy premium, buy options out of the money calls or out of the money puts when volatility is super high or ridiculously low. Those are the two times. Anywhere in between, I don't like it.
Yeah, I love how you take a quantitative approach, and that's exactly how we look at these types of strategies. So let me just clarify for that. Is there any time where you would buy an in-the-money call or an at-the-money call, or is it just buying calls in general that you think that when IV rank is that low and when you have this explosive volatility?
The only time I would buy an in-the-money call is if I'm doing a stock replacement strategy where I just feel that it's a capital efficient move to buy an in-the-money call or an in-the-money put as opposed to getting short the stock. Sometimes there's reasons why you don't want to be short a stock, and it may be because the stock is hard to borrow, or there's just a variety of reasons that you don't want to use the underlying stock. It's just not capital efficient. So if that's the case, then we would do something with an in-the-money option. Generally, when we're buying an in-the-money option, we're doing a call vertical or a put vertical.
Right. Okay, great. Hope that answered your question, Sonny. So the next question is from Igor, and this is regarding selling bull put credit spreads. And Igor had a question regarding if you could possibly elaborate on your recommended expiration dates to selling bull put credit spreads, and also your exit strategy on bull put credit spreads.
So this is a great question, and we've done a ridiculous amount of research. I mean, literally, I would say hundreds of hours, but it's probably closer to thousands. If you want it in a nutshell, Tony, this is our nutshell version. And a bullish put spread just means you're selling a bigger put than you're buying. So you're hoping that the market goes up. It's a long delta play. And in this example, we would go optimal time, 45 days, optimal out of the money strike, somewhere between meaning the strike that you're selling on the bull put spread. It would be out of the money, somewhere between the 25 and 35 delta strike, 45 days to expiration. The strike that you're buying would be optimal 10 to 20 delta strike. And what you're looking to collect is about 1/3 the width of the strikes. And when you're looking to close it, it's at 50% of max profit, or more likely at 21 days to expiration. Those are your optimal times. So just to repeat, and we're talking about pure optimal statistics. The option that you're selling, 25 to 35 delta. The option that you're buying, 10 to 20 delta. The number of days, approximately 45 days or closest to that. And you're managing the trade at 50% of max profit if the stock goes your way, or at 21 days remaining to expiration.
So let me ask you this, Tom. Do you not have when you take these types of trades, do you not have a directional view when you take them?
Oh no, if I'm selling a put spread to get long, I am definitely directional. Unlike, people think because we talk a lot about non-directional strategies and we talk about about delta neutrality and being very strategic, Tony, I am very opinionated and I'm very directional.
Okay.
I wish I had the ability to trade delta neutral through my career. Unfortunately, my ego is too big and and I'm too opinionated.
Okay, so I have two follow-up questions on that, right? Because we have done a fair amount of backtesting. It sounds like you guys have as well on the exact same strategy, and I've come to almost the exact same conclusions as far as you do. My only question is, from our perspective, we have found better results in selling the 50 delta and buying back the 25 delta. I'm curious as to kind of what your thoughts are on that.
That is completely and again, The difference is very minimal. We're not talking about, like, my response was, what I called it was optimal. And the reason that it's optimal is that the 50 delta require potentially, now of course you can make more money selling the 50 delta, buying the 25 delta, but the 50 delta has a little less wiggle room. So when you talk about optimal, the optimal delta for virtually everything, and this is a crazy number, is about 22 or 23 deltas. But that doesn't mean anything. That just means that if you said to somebody, hey, if you had to pick a single delta, okay, I'm going to pick the 23 delta. But if you want more bang for your buck, and you want something that's going to move, selling the 50 delta, buying the 25 delta is fine. The difference is very marginal between that and the 35 delta. Here's what I would suggest people, and I'll show you, like, right on this screen, because it'll make a lot more sense by just showing you. Like, what I'm suggesting here is that when we look at put credit spreads, and I'm just looking at the July and the SPYs, which is 29 days, because I just, I'm using the monthlies here. But if I said what I was saying is sell the 35 delta, and I would buy something, let's just say around the 20 delta, that would be like an optimal default put spread for us. But the cool thing about this platform is you can just take this 302s and you can just roll it down to the 92s if you want to, use less buying power, and then figure out whatever credit. If I'm selling something that's $5 wide, I'd like to collect $1.87. So this is too cheap for me. So that's why I like to, when you're going to collect a third the width of the strikes, you want to collect something you want to get a little bit of meat. You want to get a little bit of juice for your efforts.
Okay, great. I mean, this is great insight, and I love hearing another quantitative aspect to what we're doing as well. Because sometimes you view things from your own lens, and it's hard to get out of that. So I'm glad to hear a different perspective on this. That's great. So I think that's enough on bull put spreads. I think we do have a couple of other questions on this, but I do want to move on. Dennis is asking, I've been using the Tastyworks platform for years now, and based on my assumption, the Tastyworks model is more on shorting the underlying and big on probability of profit. I'd like to use OptionsPlay philosophy now. I'm using it, I'd like to use the OptionsPlay philosophy now while I'm using the Tastyworks platform. How can OptionsPlay complement Tastyworks? So Tom, I will say that, here at OptionsPlay, we do a lot of debit spreads. We love trading debit spreads because we generally, like you, take a very strong directional view. And we also have a lot of quantitative research on our end on the technical aspect of things in terms of seeking optimal opportunities on stocks that are going to make a big move in one direction or another. And that's how we use leveraged debit spreads to do that. So could you give users a quick demonstration of Tastyworks as to how you might use Tastyworks to very quickly look for a debit spread, and maybe even talk about kind of when you are trading debit spreads, what are your optimal strikes for that?
Sure. So since we're on Zoom, I'll just type in Zoom, okay?
Great.
And I have no axe to grind in Zoom or anything else. Debit spreads are essentially just very simply, they're the inverse of credit spreads. So when we talk about credit spreads, you can almost substitute a debit spread for a credit spread. The difference is we try to present things in a mechanical fashion. So that's why we'll use credit spreads when implied volatility is high and debit spreads when implied volatility is low, just to give people a sense of mechanics. But either way, doesn't make any difference to us. When you're doing debit spreads, the only difference is when we do debit spreads, and again, I pulled Zoom up here. So let's just say we're a little bit bullish in Zoom. Our classic debit spread would be to buy either the at the money strike or one strike in the money and sell, let's just say, one strike or two strikes out of the money. That would be a classic debit spread for us. So again, if I wanted to buy the 240s and sell the 250s, this would be what we would consider to be a classic debit spread. Now, you pay about 1/2 the width of the strikes, about $4.50, and the max it can go to is $10, obviously. And that's kind of an example, Tony, of what you were talking about. The only difference for us is that when we do debit and credit spreads for us, we usually sell the out of the money strike and buy a further out of the money strike. So when we do credit spreads, we sell out of the money and then we buy further out of the money. It's a higher probability trade, lower amount of money to make. When we do debit spreads, we buy one strike in the money, sell one or two strikes out of the money, and we go for a lower probability of profit, but a higher payout. And remember, risk in the world of strategic investing or in the world of options, everything is symmetrical. So there's not an advantage of doing something in the money, except for the fact that it is a higher probability of profit. Do something at the money, you have the ability to make more money. Statistically speaking, the theoretical give up is going to be the exact same. And theoretically speaking, you know, as long as you're trading something liquid, it's not going to matter. It's just a matter of preference.
Exactly. And I think that's a good point, because we always get a lot of questions from users saying, how do I seek strategies with very high probability of profit? And I think that stems from the belief that if you trade something with very high probability of profit, you'll win more often. But I think that's very important to remember. The trade-off that you have with something with very high probability of profit is generally that it has relatively poor risk to reward, and vice versa. If you have something very low probability of profit, it tends to have relatively high risk to reward.
Yeah, that you said it perfectly. You know, that is the whole trade-off in the concept of high probability trades. I mean, my philosophy and the philosophy that we built at Tasty was essentially, let's teach individual investors the concept of winning, because there's a psychological thing, which is if you make more trades and you have more winning trades than losing trades, we're hoping that will accelerate the course to being a successful trader. Our fear is that when people have more losing trades than winning trades, they get discouraged. So although you are 100% right that theoretically we're talking about the exact same thing, we think that there's a component of it which making winning trades, even though your P&L might be the exact same, is a stronger it's a stronger methodology, just because it puts people, they get excited, it gets you engaged.
Yeah, I will say I've spent 2020 spending a lot of time talking about trading psychology, you know, and the philosophy behind managing winners and losers. And I actually have a question on this later I want to come back to.
Sure.
But I think it's a really good point that you're making here, that if all things are equal, you might want to trade a strategy with more winners than losers, even though you might lose more on the losers. Net, you might feel better at the end, right?
Yeah. There's not like, in the end, there's a math equation that would suggest that your numbers are going to come out very similar. But, you know, my job is, I feel like one of our responsibilities is to get people so that they're engaged, because when you're engaged, you start to make quicker decisions, which I believe, you know, making winning decisions and quicker decisions ultimately leads to more success. And that's like brain processing. You know, the faster your brain processes things, the more successful I think you'll be as a trader.
I completely agree. Okay, so moving on to the next question. So this is a question about hedging. Specifically, I think this is useful if, let's say, you feel that the markets are a little overvalued and you're thinking about buying some hedges. The question from Usman is, would long VIX be a better hedge than short SPY? This is one that I think is interesting to explore.
Yeah, it's actually another topic that we've studied with a lot of man hours went into studying this topic. And now, the easiest way for me to explain this is that there's a lot more liquidity and there's a lot more things you can do in the SPY. And I think that people, sometimes the VIX and volatility instruments can be confusing to individual investors unless you've kind of traded them and watched them for a while. Remember, the VIX, which is, I'll show you over here, I'll just bring it up real quickly. There's no options on the VIX, but the VIX is this is the VIX future. Actually, I'll put a little chart up here so you can see it. But the VIX future itself and the VIX itself is a little bit different than some of the volatility ETFs and things like that. So when we talk about the VIX, which in this case is, I'll type it in, it's VIX. So we talk about the VIX itself. The VIX is a forward-looking cash-settled instrument. So right now we're looking at the VIX. When you're trading the VIX, which is $33 right now, you're trading the VIX for settlement in July. So you're trading a VIX right now that when you go out and look at it, it's 33 days away. That's the actual product that you're trading. When you look at the VIX future here, it's a little bit different. It's 33.60. It's about 60, 70 cents higher. That's your cash market, but that's not really tradable for you as a customer. So as customers, if you want to trade volatility and you trade the VIX, just remember you're trading a forward product. When you trade the SPY, you're trading a cash product at that moment, like you're trading a real-time product. So if you want to trade real-time volatility, you might be better off in a more liquid underlying like VXX, which again tracks volatility in real time. So our preference is, if you want to trade volatility, you're about 1-to-1 with VXX than you are with the SPY. And that's the easiest way to kind of think of it. So if you want to trade real-time spot vol, we like VXX. And if you want to trade real-time spot S&P cash, we like SPY. But as a hedge, they're very similar.
Right. But the one thing I will say is that if you felt that the markets were going to correct 10%, how much is volatility going to move up by? That's always been one of my concerns for retail in terms of trading volatility or trading or using VIX or VXX as a hedge. Is if I felt markets were going to move a certain percentage down, I can buy a debit spread for my target, but I can't necessarily target where I think VIX is going to be. That's always been my challenge.
There's a bunch of very interesting formulas that talk about a 1% move in a 1% move in the SPY, depending on where it is. Now, 1% move on the SPY here is not going to move the VIX very much. But if the SPY was 13 or 14, a 1% move on the SPY can move the VIX as much as 10%. I know that sounds crazy, but you're talking about a $13.50 VIX can easily go to 15 on a 1% move in the S&Ps. When the S&Ps are trading at 3,100 and the VIX is trading at 33, a 1% move in the S&Ps is barely going to move the VIX 1 or 2%. That's the challenge with your question.
Yeah, so I find that, I think for someone who's not as familiar with all of these things that you're referring to, it's always a challenge. I always think that it's better for retail to use SPY as a hedge as a result of all of these nuances, if you will, that we just discussed.
I would agree with you. I would second the motion.
Great. So the next question actually points back to the first thing that you talked about, which was the implied move based on the implied volatility. And the question is from Ken. He's saying that on Tastyworks, the IVX rating is, and he's referring to if you divide the IVX rating by 19 to get the per day stock movement, is his understanding of how to use IVX. And he understands that the number next to it in parentheses gives you the price movement up or down, right? That's what we just discussed at the first one on SPY. Sure. So he was saying take Apple, which has an IVX at 44, which, when I looked at this, it didn't seem like it was at 44. I think it was closer to 30 at the time, but he was saying
it's actually 36 right now. 36
right now. Okay. So he was saying that, and what's the implied move right now for 36? It's
by July expiration, it's 22.63.
Right. Okay. So I think he was looking at the June 19th expiration, which expires tomorrow. But he was saying that if you take that IVX and divide it by 19, you get plus or minus 4, as opposed to the plus or minus 8 that he was seeing on his screen. He was asking if you can help him understand. So maybe the best thing to do is just walk us through a little bit about IVX and how it correlates to the up or down move next week.
So let me explain this because I think he'll get it. Who said this? Ken? Was that Ken you said?
Ken. It was Ken. Yep.
Yeah. So Ken, this is a great question, and this has been something, putting some definition or putting some context around implied volatility is something that that we started 20 years ago when we built TOS, and then we've made it even better on Tastyworks. And that's just because we've refined the formulas over the years and things like that. But there's 2 ways to look at expected move. Now, remember, with 1 day to go in Apple, it's a little bit more, it gets a little bit, clunky or chunky when you have 1 day to go. But generally speaking, there's 2 ways to look at expected move. The first way is you can take the implied volatility rank, which in this case is 36, and you can say that 19% is a 1% move on a daily basis. So if you looked at 36, it's almost 2 times 19. So the expected move in Apple on a daily basis right now is about 2%, or right around $7, a little bit less than $7. That's one way to look at expected move. It's just to take the implied volatility, know that 19%, that's from high to low. 19% implied volatility is a 1% expected move, so that if you can just divide
Sorry, I think my audio got cut off there. Can you still hear me? Okay. I can't hear you, but you can hear me. So I unfortunately got cut off there. So I'm just going to move on to the next question while I sort out the audio here. The next question here, I actually is along the same, sort of the same realm, which is, will you take trades based on IV alone, implied volatility alone? I'm guessing IV rank or IV itself. Okay, so great. So the next question, this is Tom. We have a pretty big following here in Canada. And this was a question that was brought up last time, but we have a lot of questions. I had multiple questions this time as far as, hi, Tom and Tony. I'm a loyal follower of both of you on your webinars and YouTube shows. For Tom, I eagerly look forward to to your arrival of Tastyworks platform and brokerage services in Canada. Would you be able to share any updates? So multiple questions here from Wallace and Roe on the status of whether or not Tastyworks is going to be in Canada soon.